Hello and welcome to another episode of News of the Week. So what actually happened this week that would be relevant for us as investors in residential real estate and people who want to reach their time freedom point as soon as possible? Now, the one thing that went through the news, and you may have heard it or you anticipated it already, is that the Federal Reserve in the United States increased what's called federal funds rate by another 0.25%, 0.25%. So now the rate range in which the federal government is basically lending money to banks is 5% to 5.25%. And that rate increase was basically anticipated, but the important part in that whole step up one more little notch was the announcement by Jerome Powell, the federal chairman, that the group of people who come together every other month to look at the economy and basically find out, okay, what should we do with rates and how is employment going, changed the language, basically the perspective that they have going forward, from having always said in the last year or more than a year that they believe they will have to keep increasing interest rates to really see the necessary effect that brings inflation down and maintains low unemployment. Now, in this particular case, just this week, they said, well, they think they raised the rates enough and they will now, from now on, look at if further increases are necessary based on the data, or if they have reached the level that makes sense. Now, I want to give you a quick perspective on what is really happening here. In a long history going back more than 100 years, and you look at what has happened in phases when there was high inflation and what needed to be done to get high inflation down. Now, I'm not particularly a fan of this 2% number that the government is always talking about as if that were the holy grail, because circumstances change. Who says that for 100 plus years, the right number is 2% when anybody who looks at how our life, our culture, our technology, all these things have changed over time? But let's just leave that alone and say, okay, let's assume it would be correct to try to get to 2%. Anytime you wanted to have a significant reduction in inflation, you needed to make money more expensive. And not just more expensive in general. I mean, we went basically from almost zero interest rate to now 5% interest rates. So that's the biggest jump that has been done in this shorter period of time in decades. But the real aspect that brings inflation down significantly is when the interest rates are somewhat above inflation. And if you look just at this year, 2023, in January, it was 6.4%. In February, it was 6%. In March, it was still above 5%. So inflation is now at a level, even though it has come down a little bit lately, where the interest rates is. They kind of match. Interest is still not really above. And the other part that has always been an indicator that there is an effect of the measures that the Federal Reserve has done has been seen that basically companies couldn't keep as many employees as they used to have because employment, especially in an economy like the United States, is one of the biggest cost factors for businesses. So when the cost of money goes up, when people become more hesitant to spend money that they make, then it will be harder and harder for companies to sell their goods and services. And because of that, if they're not making as much profit or if they have to invest more in marketing, they typically let people go to reduce their cost. I don't say this is a nice thing, but those are the indicators. Interest rates a good amount above inflation and unemployment increasing. And neither of those two things have happened. So I'm a little afraid when we put the news about the Federal Reserve increasing interest rates in perspective that this statement, we will monitor the data and then decide if we need to do more, could actually give the false hope that this is the top and no more will happen. And you see some of those speculations already in the stock market. So for us, for you, for anybody interested in this, I would be pretty cautious, especially also keeping in mind, and you have seen that as the other big piece of the news this week, was that yet another bank, First Republic Bank, basically failed and was taken over briefly for a few hours by the government and then bought by JP Morgan Chase. Why is this happening? Basically, two things are occurring. Every time one of these more regional banks gets into the news, speculators say, well, I wonder if this one is also going to fail, and they do something called shorting. When you buy stocks, you're basically hoping that the company is doing well and is going, therefore, get a higher price for their stock, and you can then make a profit on the difference between what you paid and what the price increase will be. Shorting is basically the opposite. When you say, okay, I buy the right to sell the stock, and I'm betting that the company is doing worse in the future than it is doing now. So with these banks, a lot of people that have a lot of money and want to use a lot of money to speculate, they say, okay, I look at all the banks, I look at the ones that are coming into the news for struggling, and then I short this stock because I believe they're going to fail, right? And so what that also means is these banks are basically getting in the news because their share price starts falling, and it becomes kind of like a self-fulfilling prophecy. And so First Republic Bank had large outflows of deposits after they got into the news. And one of the things that a lot of people don't necessarily understand, I made a video about this, that is actually the banks were told by the Federal Reserve that they should, as a security, buy treasury bonds and put them into their reserves, so they have something in reserve if somebody wants to have their deposit money, because normally, as you know, what banks do is they take the money in that you deposit and they give it right back out for mortgages and credit card loans and car loans and other stuff. So they're not holding a whole lot of money in some kind of vault. So the government said, well, you should put treasury bonds into your reserves. The problem is when the Federal Reserve kept increasing interest rates more and more and more and more, the inverse is happening with bonds. If you buy something for $100, one bond, and interest rates keep increasing, the value of the bond keeps going down to 95, 90, 85, 80, and so forth. So if you then think about, okay, if these less and less valuable bonds are the reserves in the banks, they would either have to buy new ones or they have to reduce their loan activity, which makes a bank work. So like First Republic, for example, they had large outflows, meaning like people wanted to have their money that they had deposited, which gets to a point where the reserve value is no longer sufficient to satisfy all those depositor requests. And what do? You have those as reserves, so you have to sell them, but you sell them at a loss. You paid for them $100 and you maybe get $80. That's obviously not a sustainable business. Now, First Republic Bank got taken over by JP Morgan Chase, but that is not really a solution. If more and more banks start failing, even if just one every few weeks fails, there's no way that one or two big banks like JP Morgan or Wells Fargo can buy up all these little banks. Besides the fact that can't really be the purpose that we end up with a monopoly of like maybe a handful of banks that do all the banking in the whole country. So there is a critical thing happening, and those are two things. Maybe the stock market thinking that this news from the Fed that they may not actually go higher than where they are now could indicate that there is a point in the not too distant future that the federal rates come down again, which would be good for stocks. And at the same time, there's a risk that we have more banks failing because more and more people, when they hear the news, oh, my bank is maybe now the next one, start taking their money out and put it into bigger banks where they know bigger banks are too big to fail. You may remember that statement. So that's really the thing that has happened this week, those two things. And they impact us because obviously the more the Fed increases interest rates, we have to pay more for mortgage interest rates for our investments. For the other aspect with the banks, the problem is this could really start harming the economy because it's not so much you and me who have maybe some small deposits in these banks, but there are businesses that actually use these banks for their business operations. And when the banks, the law still says you are okay up to $250,000. Now imagine you had a company with 500 employees and everybody needs to get paid. Well, where is this money coming from? The business has that money in the bank, right? And only 250,000 of that is insured. So more and more businesses will have to ask themselves, well, how can I actually do banking if the bank that I'm working with is potentially going to fail? So this could be a real hit on the economy. So those are the two things. I hope it was informative to you. If you have any kind of comments, please leave them below. And please also tell me if you have some topics where you say, hey, not maybe in the news of the week, but in your videos in general, I would like to hear about it. Please do so. If you get this on YouTube, please subscribe and give it a thumbs up if you liked it, a thumbs down if you didn't. And if you see this or hear this as a podcast, then please give us a comment and let us know how you liked it. So until next week, be well, stay safe.